Welcome to John's Desk. In this video, we're going to talk about why, as a retail investor, it is very hard to outperform the market for a variety of reasons. Let's have a look at the most important ones. The first one is information disadvantage. Professional investors and institutions have access to more sophisticated research tools, real-time data, and expert analysis, giving them an edge over retail investors. An example of this, especially on the research tools and the real-time data, are Bloomberg and Refinitiv, which are extremely expensive for a retail investor. A license can go up to $27,000. Therefore, it's highly unlikely that a retail investor would be able to afford such a cost. And the expert analysis is also quite expensive because you also can get access to that mostly via these paid research platforms. Bloomberg is the best aggregator that there is out there of financial information. Then we have the costs, the transaction fees, taxes, and the setup costs. Especially transaction fees and taxes can significantly erode your investment returns. Some retail investors in Europe know that very well. And then, of course, transaction fees are quite high. Even the Giro and Interactive Brokers, which are two of the major players in Europe, charge their users for stocks, I think, €3 per transaction, or 0.05% of the transaction amount in the case of Interactive Brokers. It is highly expensive, I think, to trade stocks. Be careful with that. These costs make it really difficult to outperform the market for retail investors, of course. Then we go to limited resources. Retail investors typically have less capital to invest and fewer resources for diversification compared to institutional investors. Retail investors may struggle to properly diversify their portfolios or manage risk effectively. Retail investors usually have low capital amounts, and that, as a consequence, brings to limited diversification, because if you have low capital amounts to invest, you will usually tend to put everything in one basket or in one stock, whatever it is, and hope for the best. And this then reflects into poor risk management decisions, because, of course, if you have limited diversification and invest only in a few stocks, your portfolio will not be diversified, so you will be highly exposed to the volatility of the markets. Then if you invested everything in Nvidia 5 years ago, you were one of the lucky ones. But if you invested everything in airlines in 2020, hoping that they would bounce back after COVID, my friend, you were wrong. Poorly wrong. So, be careful with picking stocks. And then, of course, time constraints are another major reason of why a retail investor can't beat the market. Because, of course, normal people like us have full-time jobs or studies to do. That limits the time for research and investments, and of course makes it much harder to select stocks. With limited time available, it's very hard to choose, to focus and come to the right decisions when it comes to stocks. It's also hard to implement a system to find good stocks to invest in. And if you think about the fact that many professional investors struggle to beat the market, and they do that full time for 40, 60, 80 hours per week, then you need to understand that how can you, from your home, with limited access to data and information, be able to beat them? And then there is short-term thinking. So focus on short-term gains rather than long-term investment strategies. So this is typical of the wannabe traders, especially if you have just started trading. Your typical behavior is usually this one. So you start buying stocks just because you heard, Apple is so good, or Palantir is going to rise because you read that on X or Instagram or TikTok. You will be disappointed. I've been there many years ago, and believe me, it sucks. That, of course, the short-term thinking leads to underperformance. You will sell when the stock is going down, because maybe there's just a glitch in the market, let's call it that way, and it goes down a little, and you sell your own investment just because you think, I can't, it's going down, my theory was wrong, and then 2 months later, stock is back up in the greens, and you missed an opportunity there. And that's because maybe you made the right decision, but your timing was not perfect. And so, here also the emotional component comes into play. And regarding the emotional component, I think it's good also to have a look at the emotional biases. I put here a short list. I think I put 5. Let's look at these now. So first one is the overconfidence. Overconfidence bias is the tendency for people to have excessive confidence in their own abilities, knowledge, and predictions. And in the context of retail investing, this bias manifests as an investor's overestimation of their ability to predict market movements or pick successful investments. So the implications of this, well, it results in excessive trading. Usually people that are overconfident trade more frequently and incur in very high transaction costs, because if you trade daily, you incur in those crazily high expenses in transactions, and if you have really little capital, your gains will go all there. Even if you make some money, before you make the transaction cost back with 100, 200 or 300 euros invested, it can really have an impact on your performance. Underestimating risks is the second one. This kind of investor can take on more risk than is prudent for him, so believing that they can handle or they understand the market better than others. And then failure to diversify, believing in their superior stock picking skills. Overconfident investors might not diversify their portfolio adequately. Mitigation strategies: seek feedback, so regularly seek objective feedback and be open to critique. If you invest with friends, I highly recommend that, to meet or have calls weekly, bi-weekly, monthly with friends to discuss your personal investments. I think that really helps. Review your past decisions, so analyze your past investments decisions and outcomes to understand the role of luck in those decisions. Adopt a checklist, so I think it's important to use decision-making checklists to ensure that all relevant factors are considered. So in this case, checklists just mean double-check the investment factors that you chose for your investment. Confirmation bias. So confirmation bias is the tendency to search for, interpret, favor, and recall information in a way that confirms one's pre-existing beliefs. Investors selectively gather or interpret information that aligns with their current views and ignore opposing information. So the implication of these are the reinforcement of poor decisions. So by focusing only on confirming evidence, investors might continue holding on to bad investments and ignoring the warning signs. Important warning signals and contradictory data are dismissed, potentially leading to significant losses. How can you mitigate that? Well, first of all, seek this confirming evidence. So look for information that challenges your current beliefs. And then play the devil's advocate. Encourage someone to play the role of a devil's advocate to question your decisions. Or if you don't have anybody, you can do it yourself. So instead of asking, is this right? You should try to prove why your investment thesis is wrong. And believe me, most of the times you will end up not investing. Diversify information sources. This is relatively straightforward for a retail investor, since it's very hard to find a one source truth, because information is scattered all over the internet. You don't have access to a Bloomberg terminal or Refinitiv or whatever. So check different sources, not only Reddit, not only TikTok. Don't trust anyone. Don't trust random people on the internet like me. Always double check and triple check your sources, because it's extremely important when trying to pick stocks. Anchoring bias. Anchoring bias occurs when individuals rely too heavily on an initial piece of information, the anchor, when making decisions. In investing, the anchor could be a historical price, a target price, or an analyst forecast. So the implication of this is that investors might fixate on the purchase price of an asset, leading them to hold it longer than it is rational, in hopes of recovering perceived losses. And that is quite common. Then there is mispricing. So overall reliance on outdated or irrelevant information can cause the mispricing of assets. So you would expect that the price of something would go somewhere. For example, I don't know, you read somewhere that a government is placing a big order on Nvidia chips and the price of the stock will go higher. That piece of news that maybe you read the week before, then time goes by, you decide to buy, but that information is already reflected in the price of the Nvidia. The stock goes down, you start to lose money, and you think, oh, that source was wrong. Maybe that source was right, but you over-relied on an outdated piece of information and you lost money. How can you mitigate that? So, first step is to do regular reassessments. So periodically reassess the value of investments based on current data, not historical prices. Set objective criteria, so develop a clear objective criteria for buying and selling decisions. And then awareness training. For you guys, it could be just to understand when you're reacting on one piece of information. I know it's difficult at first, but if you train yourself to understand, okay, I just read this, I want to buy this stock. And the moment you think that, you have to think, do I really need it? And then you will start to think, let's look for other sources of information. Let's see if this is right. Let's see if there is an investment opportunity here. So always try to put brakes in your brain before acting. Herding behavior. This is one of my favorites. Herding behavior is the tendency for individuals to mimic the actions of a larger group, irrespective of their own beliefs or information. The implication of these are market bubbles. So herding can lead to inflated asset prices, contributing to market bubbles. I think you are all familiar with market bubbles as well, but if you want to know more, Google Tulip Mania, the first ever financial bubble. Then there was, of course, among the big ones, the 1929 crisis, the 2008 crisis. An interesting one was the dot-com bubble, and there's many more. One of the herding behavior is the fear of missing out, which is a specific form of herding driven by the anxiety of missing profitable opportunities that others are exploiting. For example, for me, I'm in my 30s right now. In December 2017, I bought some Bitcoin and Ethereum just because I was missing out. And 1 month later, 2 months later, I was down 50-60% on my investment. Yeah, I bought just because I thought I was missing a train there. And I missed it. I bought at the peak of the 2017 crypto bubble. I was already way out, but in that moment, you just buy. And then the last one is panic selling. Similarly, herding can exacerbate market downturns as investors rush to sell. That has happened many times in history, so just Google panic selling, you will find some very nice charts. Probably the most interesting one, October 1987. Have a look at that. How to mitigate herding behavior? Independent analysis. As I said before, base investment decisions on independent analysis rather than following the crowd. So always try to build your own idea on an investment, because then you will be, let's say, less prone to herding behavior. Long-term focus, so maintain a long-term perspective and avoid short-term market noise. Again, you're not a trader, you're a retail investor. The last one is loss aversion. Loss aversion refers to the tendency for people to prefer avoiding losses rather than acquiring equivalent gains. The pain of losing is psychologically about twice as powerful as the pleasure of gaining. So let's look at the implications here. Holding losers. So investors might hold on to losing investments too long, hoping to avoid realizing a loss. So as an example here, I had a friend that invested in airlines back in April 2020, and I think he's down on his investment 60-70% to this day. So today is July 2024, so 4 years later, and he's still holding on to his loss because he hopes that one day it will go back up. And another one is selling winners early. So conversely, they might sell winning investments too early to lock in gains and avoid the potential of future losses. So during 2021, I sold my crypto investments. I made quite some money, but if I held onto it, I could have made 4 times more just by holding it. What was it? 7-8 months longer. And cryptos I bought back in 2017. I didn't touch them for 4 years. And then as soon as they went back up, and I was up by 200 or 300%, I was already happy and I got out. And that was a big mistake. Mitigation strategies. To mitigate loss aversion bias, you should use predefined rules for selling investments, such as stop losses orders. So you can place in your broker's account a limit to when broker should sell the stocks for you. So for example, one stock is trading at 100, you are willing to lose, let's say, 15% maximum. So you put an order at 85, and if the price drops to 85, the broker triggers the order and sells the stock for you. Then there is reframing. So reframe losses as part of the normal investment process and focus on overall portfolio performance. If you trade frequently, it should be something that you think about. You can't win every single trade, so it's normal to have losses. And then the third one is, of course, to diversify. diversify investments to spread the risk and reduce the impact of individual losses. But what's the best way to diversify investments? Well, let's have a look at what I want to talk about next. You can avoid all of these biases, all of these crazy risks that people are taking daily by trading stocks just by buying the market. And for the market, it can be the S&P 500. You can buy an ETF on the S&P 500. You can buy an ETF on all world stocks, or you can buy an ETF that is equally weighted, so to have a little bit less weight on the United States exposure. So let's have a look at some of those. First of all, let's look at the top S&P 500 ETFs. So the S&P 500 biggest index in the United States covers 500 stocks, so the 500 largest US companies. And in Europe, you can get the best one in terms of pricing are the unhedged SPDR SP 500 accumulating, and then the other one here, and then the Amundi SP 500 UCITS ETF accumulating. So they are all relatively cheap, 0.03 per annum the cost, up to 0.05, so extremely cheap, but this gives you exposure only to the United States stocks. Now people argue that it's not really only the United States, because all these 500 companies buy and sell all over the world. That's in fact true, but if you want to be more diversified, there are also other ETFs to invest in. And by investing in ETF, you will save yourself a lot of time, a lot of money, a lot of fees in transaction costs, and a lot of headaches. So that's why I highly suggest that you focus on ETFs instead of stocks, because it's much easier, less burdening on your life. In my previous video, I showed the cheapest all-country world ETF that is currently available in the market, and it's now available on most brokers' platforms around Europe. It costs only 0.07% per annum. If you want to know more about this ETF, have a look at my previous video. And if you like this video, like, comment and subscribe. Cheers!